Hi, my name is Matthew and here we are at the last video in our 5-part property series. So well done on making it this far. We hope the earlier episodes have helped you to understand some of the common financial and legal elements of being a renter or homeowner. To conclude, today we're going to be talking about property and retirement. Both paying into your mortgage and your pension are ways to invest in your future. There are advantages along with considerations to both. You might be thinking of using your property, once your mortgage has been paid off, to fund your retirement. What does that look like in principle? Firstly, it could mean vacating your family home and downsizing, which you might not want to do. Secondly, you might not be able to access the money when you need it. For example, if it takes longer to sell than you anticipated or the market dips. So let's look at a commonly asked question. How can I use my property to boost my income during retirement? There are two main ways you can do this. Downsizing to a cheaper property. This could free up a lot of money, depending on how much of your mortgage is paid off and how much your property is worth on the open market. Many people do this once their children have grown up and moved out, and they don't need as much space. As you get older, it can also be easier to maintain and manage a smaller home. Taking out an equity release on your property. This is a common way of accessing money tied up in your home without having to move. There are two different types of equity release, a lifetime mortgage and home reversion. Let's look at the difference and dive into what these terms mean. A lifetime mortgage is the most common type of equity release. Just like a regular mortgage, it's a loan that's secured against your home, but the money doesn't usually need to be repaid until you die or move into residential care. This type of equity release allows you to sell part or all of your home while you remain living in it. The reversion company then gets a share of the proceeds from your house sale. This usually happens after you die or move into residential care. If there's any money left over, it'll go to the beneficiaries named in your will. It's worth bearing in mind that with home reversion, your lender will usually pay less than market value for your property. Let's look at the benefits of equity release. Firstly, you'll have access to tax-free cash that can be taken as a lump sum or in installments. Many people do this to help pay off debts, make home improvements, or to top up their income. But you can use the cash however you like. Secondly, you can enjoy all the financial benefits of downsizing, but you get to stay in your current home. And finally, you won't need to repay the loan or interest until your home is sold. As mentioned above, this is usually when you die or move into residential care. However, like all financial schemes, there are downsides and associated risks. Equity release reduces the value of your estate. This will negatively impact the amount of inheritance you leave behind for your loved ones. If you get care at home and it's funded by the local council, they may start charging you or ask you to pay more. This is because when local councils assess people for social care funding, they often consider their financial means. Equity release will increase your available funds and consequently could affect your eligibility for council-funded care. For similar reasons, it may also reduce your entitlement to certain state benefits like pension credit. So while your home can be used as a way to boost your income during retirement, it's worth considering all of the pros and cons. While you might want to prioritize paying off your mortgage before retirement, it's important not to neglect your pension. Here are a few reminders of the benefits of paying into your pension. Investing in a pension allows you to benefit from compound interest, which means you earn interest on top of your interest. Most pension savers will usually benefit from a tax top-up, which means for every £100 you pay into your pension, the government will add £25, or more for higher or additional rate taxpayers. Your pension will likely contain a combination of assets designed to spread the level of risk and reward of your investments. When you reach 55, rising to 57 from 2028, you can access your pension in lots of different ways without affecting your home. If you have a defined contribution pension, there are lots of ways to access the money at retirement. Delay taking your pension pot and leave it invested. Withdraw the whole lot, of which 25% is tax-free. Use the money to buy an annuity, which pays a guaranteed income for as long as you live or for a fixed term. You also have the option of taking 25% of your pension pot tax-free prior to purchasing the annuity. Leave the money invested and take a flexible income via pension drawdown. This also gives you the option of taking 25% of your pension pot tax-free. Leave the money invested and take it as a number of lump sums. 25% of each withdrawal will be tax-free and the rest is taxable. or you can use a mix of these options. You can find out more about accessing your retirement money in our Pensions 101 video series. As always with investments, your capital is at risk. The value of your investments can go down as well as up, and you may get back less than you invest. This information should not be regarded as financial or legal advice. Thanks for watching.